If there was $2 billion employed, not on margin, by the way, cash, so that the rules couldn't be changed like they were on the hunts, if there was $2 billion in cash employed in the futures markets, which was held for delivery, cleaning out the good delivery silver available, the short interest would literally be uncoverable. This would deliver what would, I suspect, be a religious experience to the short community.
Hey guys, I want to thank you all for tuning in. We have a very special guest, a man who you all know, but we've never had the pleasure of speaking with him before. His name is Rick Rule, and he's over at Sprott Global Resource Investments Limited. You know, we're big fans of Eric Sprott. I've always been. I think he's a straight shooter, and Rory and I were talking before this call, Rick, that I can't think of any other investment firm or global resource kind of money management firm that I'd want to associate myself with than Sprott, and you guys seem to really be straight shooters, so thanks for taking the time.
Flattery is a great way to start an interview. Thank you very much.
Well, it's true. We were talking about it, and you know, Wall Street has such a terrible, terrible name. I wouldn't want to have anything to do with any of those firms. Goldman, J.P. Morgan at the top of the list. Rory and I were talking. We said, well, maybe Peter Schiff's organization, but otherwise Sprott is at the top of the list. You guys are the gold standard. So we wanted to talk to you today about gold and silver. Gold is now busted through its 200-day moving average, and silver has broken its long-term downtrend, and things are looking good. I mean, even the junior gold stocks are up. What's your take on all of this pretty exciting action?
Well, my suspicion is that we have, in fact, put in a bottom. Your readers and listeners, particularly those who are relatively new to the market, will need to understand that we'll be in an up channel, but that the up channel will be extremely volatile. The nature of metals markets, and more particularly junior metals equities, is that they're extraordinarily volatile. And you'll see the TSXV, particularly the resource subset of the TSXV, up 15% and down 20% in this rally for no reason whatsoever. Participants are going to have both the cash and the courage to stay the trade, or else they are going to miss what I think will be an extraordinarily attractive market. You know, this is my fifth cycle, and one of the few good things about growing old is that you have seen most of these things before. And if you see them before, one of the things you learn in this circumstance is that bear markets are the very authors of bull markets. And bull market recoveries tend to reflect the bear market decline. And the viciousness, the extent, and the depth of this bear market, I believe, will be the authors of an extraordinary bull market. But once again, it won't be easy sailing, particularly at the beginning, because the volatility inherent in the sector will spook investors on the downside and will cause an over-aggressive response in the near term on the upside. So people will need to keep their wits about them to enjoy what is their due after an ugly, ugly bear market.
I want to ask you this. I was listening to the Sprott Weekly Wrap, and Eric Sprott said, and I quote, "This is only just the beginning. I think it's just the start of big things. I think we will see new highs in the metals this year," end quote. You know, after we've been beat up for the last 2 years, you almost hate to say those things because then you can have the Federal Reserve and the powers that be come back and, bite you in the butt. But it sure seems like this is the year. We see hyperinflation breaking out in certain areas of the planet. Kazakhstan had just devalued its currency by 20%. Argentina, Venezuela, so much turmoil. It just seems like everything is lining up for these metals to hit new highs.
Well, there are so many components to that question. I'll try and answer them sequentially. With regards to Eric's statement, I think forecasting new highs this year is very, very, very aggressive. I don't have the courage to make that statement. Having said that, that aggressiveness is why I work at a place called Sprott, and he doesn't work at a place called Rule. The nature of self-made billionaires like Eric is the absolute courage of their convictions. Eric, having said it, doesn't make it so, but he has been right many more times than he has been wrong in the nearly 3 decades that I have known him. I'm interested in your discussion about inflation, because I certainly see inflation about me. But interestingly, when you look at the CPI numbers posted by the US government, they would suggest to you that inflation is tame. And I'm delighted that young commentators such as yourself see through the fiction of the CPI number. The idea that the cost of living in the United States is increasing by 2.2 or 2.3% a year is silly, even allowing for the fact that it doesn't include food or fuel, which suggests that citizens don't either eat or drive. Probably more importantly, the cost of living as reported by the federal government doesn't include tax. And believe me, if I didn't have to pay the tax, I wouldn't complain about the index. But the idea, as an example, in the last 18 months that my cost of living hasn't gone up as a consequence of the income and capital gains tax surcharges, both at the state and federal level, are silly. Now, the final point that you made has to do with devaluations of currencies on the periphery. And I think this is the most subtle and most important point that you've made. It is interesting, the set of circumstances that we find ourselves in today, where a currency, a society that I see as structurally weak, the United States, is still the dominant financial instrument in the world. It interests me a lot that 4 months ago or 5 months ago, or however long it was ago, that we had the congressional budget impasse that nearly resulted in a default on our near-term obligations. The market response and the taxpayer response to our threat of default on our sovereign debt was inexplicably to bid up the dollar and bid up sovereign bonds. This seems like a very odd set of circumstances until you recognize that the US dollar, for all its faults, and US sovereign debt, for all their faults, are truly the prettiest mares at the slaughterhouse. And if we come to a set of circumstances where the investors in the global market begin to lose faith in the dollar, I would suggest to you that there is nowhere else to turn. I don't know when or if that set of circumstances will come true. It would seem like the big thinkers of the world, and by this I'm being facetious, I don't mean Eric Sprott, I mean Janet Yellen, Ben Bernanke, Boehner, Obama, Merkel, those thugs, would appear to have convinced the investing community that near-term liquidity, that is cash in the system, is a substitute for solvency. The fact that we as societies owe each other in terms of promises more than we can ever hope to repay. I'm not an economist, I'm a credit analyst, but I did get through third grade math. And my nervousness with that proposition is that it somehow suggests that if you add carefully a column of negative numbers, you come up with a positive sum. And I don't see that.
Yeah, they've been robbing Peter to pay Paul for so long that even those that are Paul are starting to wake up and say, hey, this system is really corrupt. How's this going to work out for our kids and our grandkids? And that's what we need to happen. As Eric has said, money printing has not produced a sustainable economy. Before I turn it over to Rory, who helped set up this interview with you, and I'm grateful to Rory for that, let's just connect some dots. The German regulator BaFin has recently made the public statement that precious metals manipulation is really in some ways as bad, if not worse, than LIBOR. It's certainly as serious. And that's a pretty big deal when countries and regulators around the world, China is hoarding gold, when other countries start to wake up to this Ponzi scheme. Boy, I mean, I'll tell you this, Rick, if Rory and I know what's going on, I can assure you that the leaders of Germany, Russia, and China know what's going on. We're seeing a sea change here, aren't we?
Well, yes and no. My own belief is that the big thinking community is international. And I need to say that I have no documentary evidence that this manipulation exists. I have, however, made my living in financial services for 40 years. And as a consequence of that, I think it's improbable that it doesn't exist. Look, LIBOR gets manipulated. There's lots of evidence that there is U.S. Treasury activity in index options, the so-called plunge protection team in terms of equity markets. If you have been around the Vancouver Stock Exchange, the old Vancouver Stock Exchange, for any length of time, and I was there for a long time, that exchange was rife with manipulation. So it seems highly unlikely to me that manipulation didn't take place. But what your younger listeners and viewers need to remember is that ultimately markets always win out. Uh, Markets are bigger than any other force on the planet. And one of the things that you're seeing with regards to precious metals has been very, very, very strong physical demand in the face of, let's be charitable, tepid futures markets. In 2009 and 2010, the leveraged long financial institutions expressing themselves both in GLD but also in the futures markets were taking the precious metals higher. It was in effect a leverage carry trade. When the momentum came out of that trade and short-term interest rates rose a little bit, those trades unwound. And in that sense, the market was working. What has happened since, of course, is that we have seen disintermediation in the futures markets out by the leveraged long financial institutions at the same time that acquisition of gold and silver on a cash basis by individuals has been very, very, very strong. And that in itself is a very bullish set of circumstances. Bear markets are broken and bull markets are started by the movement of assets, financial or otherwise, from weak hands to strong. And that's precisely what we've seen in precious metals markets. So, yes, there is manipulation. And no, in the longer term, it doesn't concern me a bit as a holder of precious metals.
Rory, sorry, you're next, buddy, so jump in right after I ask this question. Well, let me ask you this then. In terms of the real-world demand for physical gold and physical silver, maybe you can couch this with what you guys are seeing firsthand. But, Eric has said that the true demand for gold in the world right now is probably twice its annual supply. So they can play paper games all they want on the COMEX, over at the LBMA, LMBA, yeah, LBMA. They can play the paper games, but the point is that the real world demand for the physical stuff is off the charts. So what are you guys seeing firsthand?
Well, one thing, and Sprott money is not controlled by Sprott Inc., it's controlled by Eric personally. But unlike many bullion dealers, Sprott money is extremely well funded. That is, Eric has no debt, and he is willing to buy and sell out of his personal bullion stash. When you have an extremely well-funded bullion dealer like that running out of inventory, it says a lot about physical demand. And we're talking about physical demand in the United States and Canada. We're not talking about physical demand in South Asia or the Far East. 2 points to that, which I think your readers might find interesting or at least amusing. One is the impact of very high excise charges in India. We are in touch with, or I personally am in touch with, Gujarati Indians who regard themselves as traders. The Indian government, of course, would regard them as smugglers. And they are reporting that about 4%, 4.5% of the value of a gold shipment is what is required by way of a bribe to get gold into India. And they are absolutely delighted with the very high excise taxes on gold because it provides them with a 15% margin for their smuggling operations. And from their point of view, has done very little to cramp gold demand in India, particularly during the wedding and festival season. The other anecdote that I find interesting and amusing it is a year-old anecdote when the German government asked for delivery, repatriation of the 1,200 tons of gold that we had been storing for them. And they were told that receiving that gold would take them 7 years. Now, in the same 30-day period that drama was taking place, Chinese citizens and the Chinese government bought 1,120 tons worth of gold through the open free market and got good delivery. So one needs to think that there are two possible sets of circumstances. One, maybe the Chinese are superior at loading gold on planes and repatriating it from the market to their homeland. Maybe the Germans, after all this time, have become very lazy and aren't very good at picking up gold bars and putting them on planes. The other explanation is that there was some problem with regards to delivery. And I suspect, given that the Germans are smart enough, if they needed to hire Chinese to load gold, that the latter is the answer. I would suspect, although I have no documentary evidence, that the gold that we allegedly held for the Germans had been leased and released again. And that the German government, the big thinkers in Germany, had as large a stake in preservation of confidence in the financial system as we do in the first instance. And secondly, Probably some of the borrowers and relenders, the hypothecators of the gold that we allegedly held on behalf of the Germans, were Germans, Dresdner Bank, Deutsche Bank, uh, because the over-leveraged nature of financial institutions is not a phenomenon unique to the United States. Certainly the European banks, the German land banks, and the big German banks are as guilty as anybody else with regards to rehypothecation, with regards to derivatives exposure, and with regards to over leverage. I find it very amusing, Rory. I mean, certainly if Sprott held 1,000 ounces of gold for you, and you called us and said, I'd like my gold back. And we said, yes, okay, over 7 years. I suspect your response would be to call the police.
Yes, immediately. And with that, it sounds like to me, Rick, that would you say that the Germans possibly signed a rehypothecation agreement with the United States sometime after World War II, and that they agreed to the 7 year term because they know that the gold is gone and that they have to go and get the gold off of the open market, and in order to not, create a stir, they're going to do it, in small piecemeal situation. Is that is that fair to say?
I have no idea what the arrangement was. Given the fact that there is an arrangement, it's pretty clear to me that the gold has been lent and relent and relent.
Yes.
And I suspect the 7 year term has to do with the scheduled runoff of the hypothecation and rehypothecation. Whoever the ultimate borrower is, who may be, 4 layers down the daisy chain, needs to give it back to lender three, who needs to give it back to lender two, who needs to give it back to the U.S., who then needs to give it to the Germans. And I have no documentary evidence for any of this. It just seems to me that if there was an arrangement whereby someone who was storing gold for someone else needed 7 years to give it back, you sort of look for the easiest possible explanation. And that's the easiest possible explanation. I don't have another explanation, nor have they volunteered one.
Right. I'd like to, if you don't mind, I'd like to step back to mining just for a second. And at the very beginning of this conversation, Sean had mentioned the mining sector, moving forward, having a big move here in the first 6 weeks and first 6 weeks of this year. How do you see the remainder of this year panning out as far as the mining sector? Is this a jumpstart, or are we on our way? I mean, I know it's going to be volatile, as you were saying, but do you see this year being a lot better year for the mining sector than the last couple of years?
Well, and I want to ask, I'm going to just, my part to that question is, have we missed it? For those who missed the bottom in the Huey, for those that missed the bottom in the junior gold stocks, if they're already up 50%, you kind of left standing here going, well, boy, that was dumb. Why didn't I pile in 6 weeks ago?
The first quarter is always very strong. I mean, the first quarter was the strongest part of last year, albeit last year was a dismal year, and uh, the strongest part of the year before. So I suspect that people haven't missed it. And I would suggest that a market that's up by 30 or 40% deserves a rest. Now, it's instructive to point out that it is only the best of the juniors that seem to have rebounded. This market, I believe, has bifurcated. And I believe that the length and breadth of the Canadian junior resource industry has a year and a half, a tough year and a half ahead of it. I'm being charitable. I believe that in order to make money in this market, that you are going to have to trade cyclicality, meaning that if you regard volatility, as an example, as a risk, you should stay out of this market. If you view it as an opportunity, you should be in this market. It will be easy post PDAC for the best companies in the sector to give back 20 or 25%. And many of your viewers, sadly, will say after the market's given back 20 or 25% that this rally that we saw was a head fake, and they'll get shaken out of it, only to watch the market continue to go up. What you learn if you inhabit this market over as many years as I have inhabited this market is that it is broadly cyclical and also simultaneously very volatile. The down cycles take 4 or 5 years to play out. And a modest down cycle can cost you 50% of the portfolio values that you have in the sector, or 75% in an ugly cycle like the ones that we've been through. The good news is that the recoveries are also extremely long and spectacular. Eric Sprott was pointing out to me that his own experience over the last 30 years was that he would have a 50 or 60% portfolio decline when he, as he put it, went over the edge of the abyss, only to face a 500% or 1,000% recovery in the bull market. And if you think of it in the context of that very big decade-long math, it's a really good business. You give back half, and then you make 10 times. If you think about the math, it's extraordinary. Mm-hmm. But in order to think about the math, you have to tame your own emotion with regards to both cyclicality and volatility.
Yeah, and he did say in that weekly wrap that I listened to, and I quote, "I think the real exciting area is the equities, which I've described as the investment opportunity of a lifetime. You can see the stocks. You can see these stocks could go up 500 to 1,000%." End quote. So, yeah, we don't really follow the equities here. Stocks in particular, everybody's been so beaten up, and there's this mindset, Rick, in our camp of our listeners that you need to get out of paper assets because you can't trust this Ponzi scheme because really everything's so manipulated. How do you trust anything on paper? So in our camp, there's a lot of folks that are really primarily focused on physical. But I know that you and Mr. Sprott have grown very wealthy because you are very good at the stock game. And, the real companies pulling real material, real metal out of the ground certainly do have actual intrinsic quantifiable value. So maybe we should just talk about that real briefly before we lose you. Equities moving forward in a world really built on a paper Ponzi. How do you trust the equities if they're just sitting in your account? It's still ones and zeros on a brokerage statement.
Well, I think it's very important to choose the institution that you deal with in the first instance. I don't believe, frankly, that we're going to have a dramatic cataclysmic break on a worldwide basis. I think this is going to play out something like the 1970s did. Because for all the faults exhibited by society on a collective basis, on an individual basis, we're getting wealthier over time. If you look at the United States and focus, as an example, solely on the stupidity of the executive and Congress, you've become very dismal. If you think, however, about a society where a bunch of pimply-faced college students could start Facebook or Apple or Microsoft, you get a very, very, very different point of view. It was said about us, I think, by Churchill, and I can only paraphrase, that the Americans always do the right thing when they've exhausted all of the other options. I suspect that the correction that we're going to have as a consequence of the leverage in our society and as a consequence of the very stupid collective promises that we've made to each other will be severe, but survivable. I think that individuals need to pay a little less attention to the systemic risk and pay more attention to the greatest risk that they that they face, which is conveniently located to the left of their right ear and to the right of their left ear. Most people's worst financial wounds are self-inflicted. That's certainly been the case in my career. And so, as an example, for people who are safety-oriented, certainly the bullion is the place to be. You need to be beta-oriented. Once you've taken care of your ability financially to look after your family and yourself over time, you can, if you have the psychological preparation to do it, and if you are willing to do the work, seek alpha. And alpha is the province of the equities. You need to decide, first of all, if that's what you want to do, and then you need to do it in a rational fashion. So one example would be, not all financial services are created equally. This is going to sound like a Sprott commercial, and maybe it is. We compete in a world of financial services businesses where many of our competitors operate extraordinarily large balance sheets. I'm thinking JP Morgan Chase is an example. Extraordinary, complex balance sheets with a 5 or 6% equity slice, which is to say, parenthetically, that only 5% of the money that's operating in the business is theirs. The rest is borrowed. At Sprott, as an example, and there are other examples, we do things very differently. We're public, so people can see our balance sheet. And when they do it, they'll see $345 million in working capital and no debt. When they look in the notes to our financials and other solvent financial services institutions' financials, under the notes with regards to the notional and the real value of offsetting derivatives, our paragraph is very simple. We own no derivatives. We have sold no derivatives. Our third party and first party agent and principal derivative exposure is zero. And yes, this is partly a Sprott commercial, but it's incumbent on people who want to chase alpha that they use good common sense, both in terms of the nature of the stocks they choose and also in terms of the custody of those stocks and the nature of the financial services community participants with whom they do business.
At SGT Report, what we specialize in is quality information, and what you've just shared is information I didn't know. I didn't know you guys never delved into derivatives. You don't hold any derivatives positions, and that's extremely valuable information for anybody who is looking for somebody to trust. That's really what this is about. This whole thing that we do at SGT Report is, I've told Rory, what we are doing is we're curators of quality information. We go out and we find the best possible information from the most trusted, best possible sources, and that's the news items that we post on a daily basis in addition to the original material we post ourselves. And that's why we're having you on, Rick, and we really do appreciate your time. I think I'd be remiss not to ask you one final question before we let you go. Platinum and palladium often do not get their spin here in the gold and silver space. And we ran a piece back in April of 2013 titled, Why Rick Rule Bought $280 Million of Platinum and Palladium. Do you want to talk just a little bit about those metals, and should they play a role in my portfolio or the average Joe's portfolio?
They absolutely should. And thank you very much for running that piece. We got an amazing response from it. And it occasioned absolutely no work on our behalf. So thank you very much for running that piece.
Our pleasure.
For me personally, I think platinum and palladium have the most compelling stories of the whole suite of precious metals. In the first instance, it's important to recognize that they are precious metals, just like gold and silver. They have not enjoyed some of the traditional functions of gold and silver in Western societies, but certainly in Asian societies, Korea, Taiwan, Japan, and China. Platinum and palladium have been regarded in the way that we regard gold and silver, as a medium of exchange, as an item of adornment and utility, and particularly as a medium of exchange that's simultaneously a source of value. So in the first instance, I believe precious metals will do well relative to the alternatives, and platinum and palladium are precious metals. But more importantly, there is a supply-demand story unfolding in platinum and palladium that is non-investment related. It's utilitarian and industrial. The platinum and palladium industry has not earned its cost of capital for 7 or 8 years. It takes the industry more to produce an ounce of platinum and palladium that they sell it for. And one consequence of that is that platinum and palladium supplies have been falling. It is estimated that the above ground finished inventory of platinum and palladium is less than 1 year's fabrication demand. With gold and silver, much of the demand that we have is investment demand. It's an odd set of circumstances. It goes from a hole in the ground called a mine into a hole in the ground called a vault. With regards to platinum and palladium, something very different happens. Most of it goes up a smokestack, out a tailpipe, or sideways into jewelry. And this is what's very, very, very interesting. On the supply side, it's produced in 3 places, really: South Africa, Russia, and Zimbabwe. And each have their own challenges. South Africa is most of what you need to know because it's 70% of world platinum and 35% of world palladium. And in South Africa, the industry is labor intensive and unprofitable. Because the industry hasn't earned its cost of capital, it hasn't kept up its sustaining capital investments. The industry itself believes that they need to make $5 or $6 billion in sustaining capital investments to maintain current production, which they haven't made. So they need to invest $6 billion, but they can't because they don't earn their cost of capital. The second thing is that in South Africa, workers' wages must rise. The set of circumstances in South Africa in a labor-intensive business with regards to both working conditions and wages is absolutely deplorable. The workers' wages have to go up, but they can't because the industry doesn't earn its cost of capital. There's unanimous opinion in South Africa that the mining industry needs to pay increasing social rent with regards to taxation and royalty. So the industry is faced with a demand from society that more of the revenue from platinum and palladium mining go to the center. This is an absolute imperative, except it can't happen because the industry does not earn its cost of capital. So in the first instance, if you assume that markets work, and they always have ultimately, from my point of view, if the price of something has to go up to sustain it, there's only two alternatives. One, it does go up, or two, it becomes available. So let's look at the demand side. The utility of platinum and palladium to users on a global basis is spectacular. The air quality that we enjoy in the West today is really a consequence of small amounts of platinum and palladium used in catalytic converters to control emissions from internal combustion engines. It is instructive for your listeners and viewers to understand that only $200 worth of platinum and palladium is required per vehicle to give us the quality of air that we enjoy. You are both younger and more active than me, but I suspect in your travels, you don't notice widespread social movement, young people with long hair in universities waving signs that say, more smog, we demand poorer air quality. I would suggest to you that if the price of platinum and palladium were to double, that if there was a $200 incremental surcharge on the price of a new vehicle in the United States, which is about $18,000 on average, that the increase in cost of $200 would have no impact on demand for an $18,000 vehicle whatsoever. And this is important because if the price of platinum has to go up because the industry doesn't earn its cost of capital, and it can go up because the utility that it affords consumers is so high, I believe it will go up. I believe that it's something that has to happen and can happen, will happen.
Last question, and I have to ask this now because our readers will really beat us up in the comments if I don't. When we were talking about gold and silver, you said they come out of a hole and they go into another hole known as a vault. Now, we both know that silver, the demand for physical silver in the industrial capacity and industrial demand is really off the charts. It's used in everything, solar panels, keyboards, mirrors. It's used so widely. What's your take on
most
silver?
Used in the world.
Pardon?
Second most used commodity in the world.
Yeah, we want to just pin you down a little bit on silver. Don't you think silver's a different story than gold, Rick?
Well, silver's a unique circumstance. In particular, because silver investors are really truly manic depressives. Retail silver speculators, when the silver price is down, question their faith in their own existence in God. And when the price of silver goes up, they're ready to take a third mortgage on their house and buy more. So in the first instance, you're trading an extremely volatile commodity against a trading partner that's in fact a manic depressive, which makes it extremely volatile, which makes it a lot of fun to trade. But you have to be a contrarian or you will be a victim.
Yeah, but we think our trading partner's J.P. Morgan. We always say it's Blythe and Jamie.
Well, trading against J.P. Morgan's not a lot of fun. I've done it in the past, and I think you need to broaden your horizons.
It's dark. It's dark. I found it's a no-win situation.
But I think they're getting set up, and when I say they, I don't mean J.P. Morgan specifically. I mean the people that are taking the other side of the silver trade. One of the things that Eric Sprott has pointed out to me is that the amount of silver available for good delivery, that is in-system authenticated, hallmarked silver available for good delivery to settle futures contracts is in the range of 50 or 60 million ounces. So keep that number in mind, 50 or 60 million ounces. The futures exchanges on a global basis very frequently trade 100 million ounces a day, which means that the amount of silver available for good delivery is traded by lunch. And then it's traded again after lunch, between lunch and going home. But more importantly, another number for your listeners to consider in the context of the silver trade is that global silver supply from recycling, from fabrication, and from new mine supply is about 1 billion ounces, which means that the futures traders trade the entire new mine supply and recycling supply, in other words, the global supply of silver from primary and secondary sources every 2 weeks. I suspect, and we've done a little work on this, that cash buyers in the futures markets, that is, people who decided to buy staggered contracts over a year in the futures markets and hold for delivery, could take that market to a cash onto a cash basis. That is, they could crash the market for somewhere between $1.2 billion and $2 billion. I'm not suggesting that anybody do this, although it would be hugely amusing to watch. But the idea that silver can be manipulated down ignores the fact that silver could easily be manipulated up. And the consequence of 2 years of extraordinary physical demand in the face of the unwinding of the leveraged long carry trade in silver, expressed in SLV and expressed by the futures markets, tell me that it will be easier to make money manipulating the price of silver up than manipulating the price of silver down. And my suspicion is that the commercial interests in manipulation are just that, commercial, not political. And they will ultimately do the easiest thing to do. If there was $2 billion employed, not on margin, by the way, cash, so that the rules couldn't be changed like they were on the hunts, if there was $2 billion in cash employed in the futures markets, which was held for delivery, cleaning out the good delivery silver available, the short interest would literally be uncoverable. I've been quoted before. This would deliver what would, I suspect, be a religious experience to the short community. And I think it would be hugely amusing. And by the way, I think it's likely. I think that the commercial interests, particularly global commercial interests that aren't beholden to the US Fed, are completely agnostic as to whether they make money on the long side or the short side. And I suspect that a manipulation of the silver market to the long side would by now be easier to effect, just like it was easier to effect in 2009 and 2010.
Wow. Well, we're 45 minutes into this interview, and I think that's the breaking news. I think that's a really interesting perspective, and I'm so glad we decided to ask you a little bit more about silver. Rick, you've been very generous with your time, and we can't thank you enough for that.
It's a pleasure. Thank you for the opportunity to address your audience. It's been fun.
Well, it's our pleasure, and our guest has been Rick Rule, the founder and chairman of Sprott Global Resource Investments Limited, and he began his career in 1974, so what a plethora of wisdom and knowledge to come our way on this fine day. Thanks so much for taking the time, Rick. And do you want to call out a website or anything that you want to direct people to a website?
Absolutely. I would love it if your listeners and readers went to our website, which is www.sprottglobal. That's SPROTTGLOBAL. I would particularly encourage them to look on the homepage for Sprott's Thoughts, which is a 3 times a week blog, absolutely free to your viewers, which gives the best ideas and information assembled by the top thinkers at Sprott, including Eric Sprott, John Embry, Mark Faber, myself, and the analysts and portfolio managers that run the Sprott enterprise on a global basis.
Well, I want to thank everybody for tuning in to this one. We really do appreciate your support, stopping over at SGT Report for your news and information, where we do link to everything on a daily basis, including that weekly wrap from Eric Sprott is on our site as well. Our guest has been Rick Rule. Rick, thanks again for your time. We truly, sincerely appreciate it. We're big fans of the folks there at Sprott.
Well, thank you. We will do our very best over the next decade to continue to deserve your support.
All right. Thanks again.
Thank you.
All right. Bye-bye.